Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing we want to do is open up our brokerage platform. I've just got UAL up at the moment here. We are currently in a position on UAL. If anyone has seen any of our recent videos on how we've been managing positions, we've used UAL as an example on how we manage risk and how we make adjustments. This is a position that's just gone completely against us. This move here happened uh, after the elections, most likely due to the elections. However, obviously can't guarantee, say for sure, but I'm 99.99999% confident. This recent gap here was because of the elections. This here was because of earnings, and this here was, I have no idea why. It just is what it is. We got into the position here, and it just started moving against us from day one. And it is what it is. But anyway, we're getting sidetracked. That's UAL. We've been managing this position really well, and we just want to pull up a list of expirations. So you want to get any underlying, doesn't have to be UAL, just any equities underlying, and pull up a list of expirations. And we want to select an expiration date, and we want to select it based on how many days we've got left and whether it's a monthly, weekly, or quarterly expiration date. So we want to stick with monthlies. We want to be between 30 and 60 days. So the only expiration date that fits that criteria currently is December 20th. So now we know December 20th is 43 days out in time. We can take that information, come over to our watch list, and then simply filter out any underlying that has earnings over the next 43 days. We do not want earnings to disturb our trade. It will increase volatility, it will mess up our deltas, and all of these things will have a negative P&L, a negative effect on our P&L. And we also want to filter out anything with a low liquidity level. Now you'll end up with a list that looks something like this. Of course, this will depend on what's on your watch list, but this is just a pre-made high options volume watch list. Any decent brokerage will have some watch lists pre-made. You can make your own, doesn't really matter. We are product indifferent. And at this point, I like to sort everything from high to low IVR. And we simply just go down the list and see what would fit well in our portfolio, whilst making sure that we are looking at things with a high IV rank. We want to place trades on underlyings that have an IV rank of over 50. Sometimes over 30 can be okay, but generally speaking, over 50. And we want to just see what would fit well in our portfolio. So we just go down the list. We've had a look at Nikola, NKLA the other day. The strike selection wasn't great. It's quite a small underlying. And we've got X, GLD, Delta Airlines. Airlines seem to be fairly volatile recently. We haven't had a look at PTEN, Patterson UTI Energy. We haven't had a look at that before. And just having a look at it, it's trading at just over $8. There probably won't be much strike selection there, so we're going to skip that. We've got SMCI over here with a really nice IV level of 147%, which is kind of crazy. It's got an IV rank of 62.8, which is even crazier, and it's currently trading at $25. So let's just have a look at that, see if we can pick up some nice premiums. And this is the options chain here, and we simply at this point want to sell one call and one put, and we want to sell them around 15 to 20 deltas out. So on the call side here, we've got a 17 delta, and on the put side, we've got an 18 delta. And that basically creates a range between 18 and 40. And of course, there is a little bit of skew here, but that's absolutely fine. We just want to stick with the deltas. And that's basically it. This is the trade setup. We would collect $247 up front. The broker would require just under $800 in buying power. So this is a really nice high return on capital trade for a naked position. We've got almost 70% chance, 70% probability of profit. We've got an 86% chance of hitting 50% of max profit at some point over the next 43 days, at which point we could just close out the position, which would give us a success rate of about 85%. So very, very high probabilities of success, very high return on capital. This is a naked position, so we are going to enjoy the benefits of a more aggressive theta decay as opposed to with it being a covered position. With this position only requiring just under $800 in buying power, and with it being such a high return on capital, I wouldn't recommend necessarily buying any longs or going long on any contracts. Buying any contracts, I should say, to cover the short positions, the short contracts, um, because it doesn't require too much buying power in the first place, and it does give us a nice return on capital. However, if you really wanted to, by all means, you can just buy another contract, say $3 further out on either side. That will reduce the premium up front, but it will also reduce the buying power that's required as well. And this, even though the return on capital was high before, the return on capital is even higher now. And the trade-off here is we will have less daily theta decay and we have lower probabilities of profit. So that's the trade-off. And how do you know how much buying power you should be allocating to your positions? Well, in order to figure that out, we've created a position sizing template. The link is in the description. It's free. Click on this position sizing template and it will bring you to the spreadsheet. And the way it works is you enter in the size of your portfolio here, and then you enter in the current VIX level below, and then everything below that will be automatically calculated for you. All you need to do is just use this to form the backbone of your portfolio. It will tell you the maximum amount of buying power to allocate to any single undefined risk position, defined risk position, and how much of your portfolio you should allocate to short premium strategies in general. Because if you've got, say, 100 grand in your account, you should not be using 100 grand in buying power. That's just crazy. Um, so as long as you stick to this, you'll be fine. Link for that is in the description. If you want to learn more detail, again, click the link and come over to EDS Premium, get yourself signed up. Inside EDS Premium, you will have access to our portfolios that will allow you to see what positions we're placing, um, any adjustments that we're making, how we're managing risk, etc., all in real time. You can use it as inspiration, you can use it to learn, or you can just simply copy us. It's completely fine. There is also a full course inside, so no prior knowledge is required. We will teach you absolutely everything that you need to know. And it's also a private community. So if you get stuck, you can speak with myself directly or with other like-minded individuals that are also inside. There's a 100% money back guarantee. So after 6 months, if you've studied the full course and followed our positions and you haven't seen results for whatever reason, then we will work with you for free until you do, or you can simply request a full refund. So it's completely risk-free on your part. And right now it is £1 a month to join. Once you're in, you're in. The price is locked in. The price will be increasing in the future though, however. So you are definitely rewarded for getting in early. And with that being said, I will see you guys on the inside.